What's going on, guys, and welcome back to another video. So ever since last March, when the markets firstly tanked, it's been a crazy year ever since, and it's hard to think that it's already been 1 year since the original crash. Since then, there's been plenty of highs and lows in terms of the market. So in today's video, I want to discuss the potential of a new bull market starting, and we're going to have a very brief look through my overall portfolio, look at some news articles and catalysts to suggest this, and finally, we'll look at my plan going forward to counteract this. Here we are on my trading 2-on-2 portfolio. Again, we'll keep this very brief because we do a lot of in-depth videos within my portfolio. But as it stands, we're currently sitting at €7,888.10, and we're up about 12.39% or €870. Over the last week alone, we can see from the graph that about a week ago we were sitting at about 7,450, and we can see ever since how it started to increase in value as the markets began to recover. Even a good comparison would be yesterday's video, which I link in the description below, where I run through each of my 30 stocks to see how they're performing from worst to best. And even the two bottom stocks here, Tesla was down 21% and iShares Global Clean Energy was down 14.3%. And I just checked there, and now Tesla is only down about 5%, so that's nearly 15 or 16% increase in 1 day alone. And the iShares Global Clean Energy was down 14%, and it's now down about 5%. So if you want to stop this video at any time, you could have a look through this chart. Again, we won't look into it because we did yesterday, but a lot of these companies, even the ones in the green, are after going up even more over the last few days. So even over the last few days is a prime example why dollar cost averaging as a long-term investor is a very good idea. Over the last few weeks alone, I've invested probably a further €1,000, and I really did get in a lot cheaper prices in a lot of stocks that I already held, effectively give me an overall cheaper price, which in the long term will give me more of a profit. Testing too about dollar cost averaging is that anyone can do it. For example, it's quite straightforward. You literally just buy more when it goes into the red. Again, it's worth stressing that you don't put all of your cash reserves in at any one time. You trickle feed the money in. So for example, if Coca-Cola was €100 today, it dropped to 90 and you wanted to invest further, but let's say you put in half of your capital, but it could easily drop down to 85 or 80. So by having that purchasing power, it gives you a better advantage over the long term. Again, if Coca-Cola went up to 110, all well and good, the original shares you bought are up in value, and that a cash reserve of 50% of your overall cash that you still have, you can either 1, wait until it drops in value again, or 2, look for another opportunity and dollar cost average into any of your other stocks. Let's have a very brief look through how each sector is performing. Again, I won't go into each company. If you would like to stop the video at any time, you can see how each is actually performing on the right here. Communication services up 26.78%. Consumer discretionary, we're down 1%. Again, that's just due to Tesla, but as I said at the start of this video, Tesla was down about 21 or 22% at the start of this week, and it's already after recovering 15% since then, so I'm quite happy with that. And again, in the next few days or weeks, I do feel that this sector will go back into the green. Consumer staples, we have 3 stocks, we're up 1.9%. Energy, we're up 20.35%. Again, with iShares Global Clean Energy, that has recovered about 5 or 6% since yesterday alone. ETFs, we're up just under 16%. Financials, we have 5 companies here on the right, and we're up about 33% overall. Healthcare, we're up 8.4%. Industrials, 13.6%. We have nothing in materials at the moment. The one penny stock I have is HITIF or High Tide. Again, I'm only putting a tiny amount of capital in here. We're down about 5% at the moment, but I'm going to slowly trickle funds in, especially even if the company continues to dip in value, as I do believe in the long term this has a lot of potential. But again, that's for another day's video, how I like High Tide. Real estate, we just have the one stock up 4.25%, and technology sector is my biggest holding so far. We're up 14.6%, and I have €1,300 invested. So as I said time and time again, markets are cyclical and they need to move up as well as down. So that's a healthy market. For example, if the market continued to go up continually, it just rises to hyperinflation. Now we've seen what happened in China or Japan over the last decades in terms of a hyperinflated market and a crash the economy. So by having such corrections and, let's say, sell-offs and buys, it really does kind of give a healthier market condition overall. So that's the reason why I didn't panic sell, and I was kind of indicating why you shouldn't panic sell either. Again, I'm not a financial advisor, but it was just my own opinion of why I wasn't panic selling, because markets have to go down as well. And you can see time and time again, if you look over graphs, even the S&P 500 over the last 10 to 15 year period, every few years it has to have a fairly big correction and sell off, and it always kind of inevitably comes back in a bull market. So we can see online here or on screen that MarketWatch has an indicator that 3 different sectors, again, there's importance of diversification as well that I always mention. They have 3 sectors here which indicates that a bull market is on the horizon. Now I'm sure there's hundreds upon thousands of different indicators that people kind of obtain or believe tells you how the market is going to perform, but again, the market has a mind of its own and it's impossible to actually predict the bottom or the top of a market. And to be honest, if someone does say that to you, they're pretty much lying. So an indicator here of the Ned Davis research, again, this is only one method of research for the bull or bear markets, states that 3 sectors that if they're starting to do well indicates that a bull market is on the horizon. And they are, as we can see on screen, consumer discretionary, the healthcare sector and consumer staples. All 3 of these sectors I've been dollar cost averaging into over the last few months as they were in the red, but now thankfully they're slowly starting to recover. Now you'd be surprised how much of an effect some big influencers such as Cathie Wood and Ark Invest have on the market, either rightly or wrongly. But for example, if they said like buy Coca-Cola, the whole market would buy Coca-Cola, for example. But in my opinion, it's always reassuring to see such big and renowned investors as Cathie Woods stating that these recent sell-offs are offering great buying opportunities. Again, that's my own kind of philosophy as well in terms of sell-offs and dollar cost averaging. Again, as a long-term investor, you can't really go wrong when buying companies on the dip. As you know, in the long term, they will eventually come back in value if no fundamentals have actually changed. So in the video on screen, Cathie Woods discusses highly of, let's say, Invitae and Tesla, and how this recent dip is posing great buying opportunities for any investor that wants to hold long term. Now, I would suggest as well that you would not put all of your eggs into one basket, firstly, and second of all, that you should not invest all of your cash reserves. You should always have some cash on the sideline, just in case the market dips even further. Though I'm going to discuss that in the next article. So as JP Morgan suggests, the market correction might only have started, and now you know the markets have a mind of their own and it's impossible to know which way they're going to go at any given time. The market isn't straightforward and it doesn't just go straight up or straight down. It usually has a more of a V-shape or W-shaped pattern. So Morgan Stanley have stated that the markets have kind of entered a bull market stage. However, that could be short-lived, and also that it might be another few weeks of corrections and sell-offs before the real bull market starts to take place. Now that's why I really do feel that the importance of having cash on the sideline, because let's say if you did buy in, the market could drop even more. Again, in the long term, they will go back up, but it's always good to get in as cheap as you can into a stock. So that's why it's great and imperative, in my opinion, to always have a cash reserve. Now you could also pose the question of saying, hang on, since last March, since the original big dip, there has been a bull market run if you looked at the 1-year chart, but it's worth noting, and MarketWatch say this as well, that the average bull market since 1957 lasts on average over 5 years. So it's not a year or two on average. The markets do kind of go on an uptrend for between, on average, 5 years over the last 60-ish years. Also on Economic Times, we can see such big renowned investment managers stating how they're going to play this bull market and how they are kind of as well, they're kind of throwing caution to the wind as such, stating that there could be some minor pullbacks before this correction, essentially start leading into a new bull market. So that's, again, without repeating myself, you need to have a cash reserve to take advantage of this. They're also stating such sectors as the banking sector as sectors they're going to be looking into to take advantage of this bull market. Now, when we looked at my overall portfolio a while ago, in terms of my financial sector, they're all up fairly well. On average, we're up about 33% within each of those companies. So if they're only starting to correct now, I say this overall banking sector in my portfolio will only strengthen over time. And that's really the importance of diversification, because let's say the financial sector could go well up 10-20% in the next few weeks. However, other sectors such as communication services, consumer discretionary or whatever could easily drop the opposite way, 5 or 10-20% in the red. So it's really important, especially in volatile times such as we're in now, to always be diversified. In terms of how I will kind of take advantage of this market, is essentially I'll be doing the exact same thing as I'm always doing, dollar cost averaging. Now, if there is a bull market on the horizon, there'll be less opportunities to dollar cost average. However, one of the main reasons why I have 30 companies within my portfolio is to have a vast array of different stocks across different sectors, firstly for diversification, But second of all, to always kind of have the opportunity to dollar cost average. So there'll always be a stage, in my opinion, where any one of those 30 companies or even more will be in the red or kind of back to parity. So in that scenario, over the next few months, it's not to kind of buy in when all the stocks are going up, as crazy as that sounds. What I'll be doing is building up a cash reserve and waiting patiently for any of those 30 stocks to go into the red or even go back to parity, as I said, and start pumping into those stocks. As well, over the next month or two, I'd like to get my overall portfolio value up to 10,000, which would be 10% of the way towards my overall goal of having 100,000 invested in the market. Now, as you can imagine, when we're actually buying a house at the moment and saving up for the wedding next year, there's kind of a lot of that cash that I get paid gets tied up into that, which again is understandable. That's part of life, I suppose. But whatever cash reserves I have because of the lockdown, I have a lot more savings because you can't really go out effectively or socialize. So what I've been doing with a lot of that money is saving it up and kind of starting having cash reserves ready to pump into the market. That's pretty much it for today's video. If you found it any way helpful or interesting, it'd be brilliant if you consider subscribing if you're new around here and smashing that like button. And most importantly, if you have any questions, comments, queries or suggestions, please don't hesitate to comment below and I'll be sure to get back to you as quick as I can. I'd also be interested to see your opinion if you believe that a bull market is on the horizon. Thanks very much guys, enjoy your Wednesday and I will see you all in tomorrow's video.